Welcome to The Explainer. Today, we are taking a deep dive into a really fascinating company, Iridium Communications, the one with that satellite network blanketing the entire globe.
And I mean that literally. Iridium runs the world's only truly pole-to-pole satellite constellation. We're not just talking about covering cities and towns. We're talking about the highest mountains, the most remote oceans, even the polar ice caps. If you absolutely need to be connected anywhere on Earth, they are pretty much the only game in town. It's an incredibly powerful position to be in.
And that right there is the million-dollar question we're here to investigate. Does having this unique global network automatically make it a great long-term investment? We're going to find out. We'll look at the business itself, the management, and of course, the numbers, to see if we can build a solid case.
Okay, let's start at the beginning. To really get a handle on this, we need to understand what Iridium actually does day to day. How does this whole space infrastructure thing work?
The easiest way to think about it is like a utility company, but in space. They have this constellation of 66 interconnected satellites zipping around in low Earth orbit. And they provide everything from voice and data to services for the Internet of Things, IoT. You also see PNT on there. That's for hyper-accurate navigation. But the real magic is this. Once the satellites are up there, adding a new customer costs almost nothing, and that leads to incredibly predictable, stable cash flow.
So, how does a company with such a unique setup defend itself? I mean, what stops a competitor from just doing the same thing? Well, in the investing world, we call this an economic moat, and as you're about to see, Iridium's is pretty darn strong.
A massive piece of that defense is just how they make their money. You can see here, a whopping 73% of their business comes from high-margin, recurring services. This isn't about selling a piece of equipment one time. This is subscription-like revenue, and a huge chunk of that is locked in with incredibly stable, long-term government contracts. So let's break it down. You can really think of their moat as having four massive pillars. First, they have the only truly global network and the exclusive spectrum rights to run it. Second, the U.S. government is what you call an anchor tenant, providing super stable revenue. Third, they don't even sell directly to most people. They have this huge ecosystem of over 500 partners that do it for them. And finally, their satellites are built to last, which means no huge spending is needed to replace them until after 2031.
But here's the thing. They're not just sitting on that solid foundation. Not at all. They're building some really exciting new growth engines. Their PNT service, that's positioning, navigation, and timing, provides a signal 1,000 times stronger than GPS. They're also launching a service in 2026 that will connect directly to standard smartphones. And their already established Internet of Things business just keeps on growing.
So the business model is clearly strong. But who's steering the ship? Because you could have the best business in the world, but with poor leadership, it can all fall apart. So let's take a look at the management team and see what they're up to.
Well, the numbers really tell the story here. In 2025, this management team showed a crystal clear focus on returning value to its shareholders. They spent $186 million buying back their own stock, which actually reduced the total number of shares out there by about 8%. On top of that, they paid out another $63 million in dividends.
And look, it's not just what they do, it's what they say. The leadership team has been incredibly consistent. Their goal isn't just reckless expansion, it's about focusing on high-return growth while actively paying down their debt. That's a level of discipline that's honestly pretty rare in this industry.
All right, now for what might be the most crucial part of our investigation. The business is strong, management is disciplined, but what is the company actually worth? It's time to run the numbers. When you're trying to figure out what any company is truly worth, the number that matters most is its free cash flow, the actual cash that's left over after running the business. In 2025, Iridium generated nearly $300 million of it. That is a serious cash machine.
So what you do is you take that powerful cash generation and you project it out into the future. Using a standard method called a discounted cash flow model, we get a total value for the entire company, its enterprise value, of just over $6 billion. But we're not done. From that total value, we have to subtract all the company's debt. And when we do that, we get to the bottom line, an estimate of its intrinsic value, or a fair price of about $42 a share.
Now, of course, any model like this is just an educated guess. So let's play with the numbers a bit. In a more optimistic scenario, maybe the value is closer to $50. In a pessimistic one, maybe it's around $37. With the stock trading around $43 recently, this tells us it's probably pretty fairly valued right now, without much of a discount or margin of safety for investors.
Okay, so that's the fundamental story, the nuts and bolts of the business. But there's a whole other way some analysts look at stocks, using charts and market psychology to guess where it might go next. So let's see what those charts are hinting at for Iridium.
Now, this type of analysis is called an Elliott wave count, and wow, it paints a very bullish picture. It suggests the stock could be in the early innings of a huge move higher, maybe up towards the $90 or $95 range. But, and this is a big but, you have to take this with a giant grain of salt. This stuff is highly subjective and is absolutely not a guarantee.
But on the flip side of that rosy projection, there's a major warning sign flashing right now. An indicator called the RSI is sitting at 88.73, which is considered extremely overbought. In simple terms, that means the stock has run up very fast very recently and might be due for a cool down, even if the long-term trend is still pointed up.
All right, we've gathered all our evidence. We've looked at the business, the management, the valuation, and the charts. Now it's time to put it all together and synthesize our final investment thesis.
And what we're left with is a classic investor's dilemma, a real tug of war. The bull case is fantastic. You have a high-quality company with a wide moat, gushing cash flow, great management, and new ways to grow. But the bear case is just as compelling. The stock's already trading near its fair value, which means there's little room for error, and the recent price surge has pushed it into technically overbought territory.
So that leaves us with the final question, and this one is for you to think about. How do you weigh all this evidence? Is the undeniable strength of this company's moat enough to justify buying it at today's price? Or is patience, waiting for a better opportunity, the smarter play?